Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
Few equities on NASDAQ right now are as polarized or as structurally volatile as Upstart Holdings, UPST. We're really witnessing a battle between these extreme technical forces and a profound macroeconomic skepticism. The stock is just under intense pressure, defined by an almost unprecedented short interest. It's hovering near, 31.38% of the float.
And that is the number. That's the number that just dominates this whole discussion. It signifies a massive sustained conviction that this company is, fundamentally impaired, not just overpriced. And that 31% short interest is propped up by another critical metric. The days to cover is dangerously high at 8.61 days.
Exactly. And that days to cover ratio, it isn't just some abstract statistic, right? It represents a physical, a mathematical constraint on anyone who is short this stock. If a meaningful buying event starts, those short covering orders would eat up almost 9 full days of average trading volume. That mathematically guarantees a vertical price move.
Right.
So that brings us to the core question here. Given UPST's recent pivot to GAAP profitability and, the regulatory clearance, is this stock a coiled spring just primed for a historic short squeeze? Or is it a value trap where macro credit risk and valuation compression are going to ultimately prove the bears right?
Well, I'm going to argue for the latter. I'll acknowledge the technical setup, sure. It creates potential for temporary volatility. But I'm contending that this technical risk is just the shadow cast by a much deeper fundamental reality. The market is pricing UPST like it's a pure software company, a high-growth tech platform, while completely ignoring the acute, structural macro credit risks that make it uniquely vulnerable to failure. It's a high-risk value trap.
See, my thesis holds that the operational success and the market structure, they're now aligned for a significant move up. For years, the whole bear case was based on insolvency, right? The idea that the AI lending model just couldn't work profitably in a high interest rate world. That premise was just thoroughly dismantled by the Q3 2025 results. The company hit GAAP net income of $31.8 million. And that came alongside 71% year-over-year revenue growth to $277 million. This shift to GAAP profitability it's critical. It proves the core business model works under the strictest rules, not just, adjusted metrics.
I understand the significance of GAAP profitability, but it doesn't really insulate them from macro shocks.
Hold that thought. Beyond just being profitable, we saw the removal of a massive regulatory overhang. The SEC concluded its investigation in March 2025 with no enforcement action. That is huge because it immediately removes a major compliance roadblock. It clears the way for institutional capital that was previously restricted, pension funds, big endowments, to finally get into the stock, adding more fuel to the buy side.
Okay.
And the engine is performing. Their newest modeling layer, Model 19, is working. We see stable vintage performance in the 24 and 25 securitizations, and efficiency is soaring. That conversion rate jumped to 20.6% in Q3. The business is battle-tested, it's profitable, and it's structurally de-risked.
I just don't buy that these operational improvements are enough to mitigate the structural weaknesses that are just inherent in their funding model and the credit cycle. I mean, why, if the solvency risk is gone, does that massive 31+% short interest persist? This isn't just hedging. This signals an enormous, high-conviction directional bet on failure. The shorts are betting on credit normalization failing, driven by macro headwinds, specifically the recent tick up in unemployment to 4.4% in December.
But 4.4% isn't, that's not historically catastrophic.
It's the trajectory and the threshold that matters. Any spike above that could cause a rapid spike in delinquencies, and that would breach those critical securitization loss triggers. That's the trigger that shuts down their marketplace funding. And on top of that, we can't ignore the valuation disparity. The stock trades at roughly 4.5 times forward sales. That's a massive tech premium compared to balance sheet lenders like Lending Club, which trades closer to 1.8 times. That premium, which is the core of the bull thesis, it just vanishes the moment the market decides UPST is just a cyclical, high-risk lender, which, Despite all the AI talk, it fundamentally still is.
That's a fair point on the valuation, and yes, it's highly priced. But I would frame that high valuation as a reflection of the acute technical asymmetry in the stock structure. When we analyze the actual effective float that's available for trading, the situation becomes, well, far more explosive than that headline 31% figure suggests.
You keep mentioning this effective float. Why is that number so different from the reported float?
Because the reported float includes all these shares held by passive funds, big ETFs, index funds, insiders, who are highly unlikely to sell during a short covering event. So when we account for these, let's call them inert shares. The estimated active float is only about 46 million shares. So suddenly that 31% short interest becomes approximately 58% of the active float. That scarcity, that incredible constriction of available shares, means any concentrated buying pressure immediately sends the price vertical.
So what you're arguing is that institutional buyers like Jericho Capital, who added 3.6 million shares in Q3, essentially taking them out of your active pool, they're strategically choking off the supply, forcing the shorts to fight for air?
Precisely. And this scarcity is being amplified by dynamics in the options market. We're seeing a highly bullish put-call ratio of 0.37. This creates the potential for what we call a gamma squeeze. And for listeners, a gamma squeeze just means that as the stock price rises, the dealers who sold call options are forced to buy the underlying stock to hedge their exposure. That forced institutional buying just accelerates the move and turns volatility into a runaway train.
Okay, I see why you think the technical setup is explosive, but let me offer a different perspective on why the shorts are not intimidated. They're not scared by the cost of maintaining their position. The constant cost of carry, borrow fees between a minor 0.35 and 0.55%, is frankly irrelevant compared to the profit potential from a catastrophic credit event. They're betting on the macro risk, and that bet is sound.
But if the cost is so low, why not just cover some? The risk-reward seems so skewed by the technicals.
Because the stock is priced for perfection. It implies a valuation of what, $75, $80 plus? And that's in a scenario where the U.S. economy has a flawless soft landing, avoids recession, and rates fall just enough to juice volume. If that 4.4% unemployment rate filters through to borrower solvency later this year, the potential downside vastly outweighs the minor cost of carrying that short. They're holding their ground because they believe the price reflects an unsupportable optimism. And this all leads us back to the reliability of Model 19 under genuine rapid economic stress. I mean, we saw a disaster in the 2021-2022 vintage. When the environment changed rapidly and stimulus dried up, losses exceeded 15, even 18%. That was a significant failure that forced them to hold loans on their own balance sheet. That history suggests the AI models, trained primarily on historical data, failed to anticipate a rapid, stressful macro shift. Why should we believe Model 19 is truly immune to the next black swan?
I'm not convinced by that because it ignores the foundational reason Model 19 even exists. It is explicitly a response to the 2022 failure. It wasn't just a minor update. It was a conceptual shift designed for macro responsiveness. It's been trained on a massive dataset, 82 million repayment events, which lets it statistically decouple borrower-specific risk from broad macroeconomic shift risk far better than its predecessor ever could.
But how does training on historical data truly prepare them for a scenario that hasn't happened yet? If we hit 5% unemployment next year, how do we know the model won't fail again?
Well, we have external validation today that suggests stability. KBRA, a major rating agency, assigned stable credit enhancement ratings to their recent Trust 2025-4 securitization and affirmed the prior trusts. This tells you that the external credit markets, the people taking the actual risk, they believe the bleeding from those 2022 vintages has stopped and that the new cohorts are behaving predictably. And furthermore, the structural weakness you cite, that reliance on third-party capital, it's been dramatically de-risked. Yes, if ABS spreads widen rapidly, their margins shrink, but the company has secured these long-term committed capital agreements, most notably that $2 billion partnership with Blue Owl and the BlackRock MOU.
These deals guarantee a committed buyer of last resort for a huge chunk of their originations. That provides a critical floor to their funding, de-risking the business model compared to the fragility we saw in 2023.
They've gone from being a desperate bag holder of loans to a true marketplace with secured backing.
But that secured backing still comes at a premium cost that fundamentally undermines their competitive advantage against banks. That is the structural weakness that remains. I mean, banks like SoFi, they use low-cost stable deposits, costing them maybe 4.2%. Upstart is reliant on the more fickle capital markets, which fundamentally restricts their margin and their scale in a tight credit environment. And that is why the high price-to-sales multiple is just flawed. They're competing with banks, not SaaS companies. Now let's turn to the persistent negative optics of insider selling, which undoubtedly fuels the bearish sentiment that translates into that 31% short interest. The magnitude is it's unavoidable. CEO Dave Gearward has sold over $200 million worth of stock since the IPO, including a notable $3.5 million transaction back in December of 24.
I understand the optics create what you call cognitive dissonance for investors, but we have to look at the technical reality of those sales. The vast majority were executed under pre-scheduled Rule 10b5-1 trading plans. And for those unfamiliar, a 10b5-1 plan is set up way in advance. It prevents accusations of trading on insider information. This is just necessary diversification for an executive whose wealth is so overwhelmingly concentrated in one company. It's not a panic-driven liquidation that signals a lack of faith.
But isn't the act of pre-scheduling a $200 million liquidation during extreme volatility still a problem for investor confidence? The optics of the CEO selling while arguing the stock is undervalued, that creates a clear credibility gap that the shorts exploit to maintain their conviction. And let's not forget his $15 million compensation package in 2022, during a period where the stock had collapsed over 90%. I mean, that suggests a serious misalignment with shareholder interest during times of maximum pain.
That compensation package is a separate historical governance issue, but let's focus on the signal of current trading activity. If Shewar truly believed the company was headed for systemic failure, he would liquidate outside of the 10b5-1 plan, signaling immediate distress. His reliance on the scheduled plan suggests a long-term organized view, but more importantly, we have a clear counter-signal that overrides the noise of those sales. The CTO and co-founder, Paul Gree, the architect of Model 19 itself, he purchased 20,000 shares in November. Insider purchases, particularly from the key technologist who knows the engine's internal health, are statistically far more predictive of future outperformance than routine planned sales.
You're asking investors to ignore $200 million in sales spread out over years and focus instead on a single, albeit relevant, 20,000 share purchase. That's a hard sell when credit risk is spiking.
It is a difficult weight to balance, but the significance of the shift to profitability just cannot be overstated. So to summarize my position, the debate is no longer about survival. It's about profitable scale. The business is fundamentally sound. It's achieved GAAP profitability, the regulatory overhang is gone, and the macro tailwind of expected rate cuts should inject massive volume back into their high-conversion model. When you combine those healthy fundamentals with the truly explosive technical setup, that 31% short interest on a highly constrained float, the risk-reward is profoundly asymmetric. The downside is arguably contained, maybe capped near $30, while the upside potential, fueled by a squeeze and rate cut volume, could easily propel the stock toward $80 or more.
And I have to reaffirm that the bullish valuation, that 4.5 times forward sales multiple, and the high growth estimates are entirely contingent on a flawless economic environment. The elevated unemployment rate of 4.4% remains the sword of Damocles hanging over this company. Despite the improvements to Model 19 and the secured funding, structurally, UPST remains uniquely vulnerable to consumer income shocks and the fickle nature of the ABS capital markets. The short sellers are betting on this fundamental fragility, and until that unemployment rate moves convincingly lower, the potential for a catastrophic credit event outweighs the technical squeeze opportunity. This remains a uniquely high-risk trade.
It's truly a binary trade, defined by market structure colliding with macroeconomic uncertainty. Volatility seems, well, it seems certain, regardless of the ultimate direction.
Exactly. And the enormous dispersion among professional analysts, with targets ranging from $20 on the low end to over $80 on the high end, that perfectly captures this binary risk-reward. It leaves investors to weigh the undeniable technical squeeze potential against a deteriorating consumer credit cycle.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.